Imagine your boss calls you into the office on a Friday afternoon. They slide a piece of paper across the desk. It is the promotion you have been working toward for 3 years. You are moving from manager to director. Your base salary is jumping from $130,000 to $160,000, a massive $30,000 raise. You shake hands, you celebrate, you call your family. But by the time Tuesday rolls around, you are already poorer than you were on Thursday. Here is exactly how that happens. Society views turning down a promotion as an admission of defeat or a lack of ambition. We are conditioned to believe that a bigger title equates to greater financial security and a higher standing in the world. The fundamental axiom of the modern career is perpetual vertical motion. Always take the raise, always take the promotion. Higher gross salary equals higher net worth. But when you strip away the ego and run the cold, hard numbers on the marginal returns of corporate Ascent, you find a massive mathematical trap waiting for you. Before we tear down the illusion of the corporate ladder, hit the subscribe button. The best return on investment you can get for your time today is joining a community that values math over hype. I am Tom, and I look at personal finance a bit differently. I do not care about your gross revenue, your impressive title, or what your neighbors think of your driveway. I care about your net free cash flow. I care about the actual leverage you have over your own time. The problem we face today is that the average American continues to operate on an outdated gross income paradigm. We conflate the salary we are offered with the wealth we actually get to keep. We completely ignore the escalating operating expenses, the time sacrifices, the stress, the taxes, and the outsourced living required to generate that larger paycheck. To understand why we fall for this, we have to look backward. We have to look at why our parents and grandparents gave us this career advice in the first place, and why it is now mathematically broken. The conventional wisdom telling you to always take the promotion is actually an artifact of a bygone era. It is a leftover mindset from the mid-20th century economic boom, a time when the rules of wealth creation were fundamentally different. During that post-war period, linear career progression yielded linear wealth creation. Tax structures were different, pension plans were the norm, and the baseline cost of living was relatively low compared to wages. If you got a 15% raise in 1970, it translated almost directly into a 15% increase in your actual standard of living. You could buy more, save more, and comfortably expand your life. Corporations historically rewarded this vertical advancement with immense loyalty, real tenure, and rock-solid job security. The unspoken contract was that if you gave them more of your time and took on more responsibility, they would ensure you were taken care of for life. Value was measured in pure industrial age output metrics. You put in the time, you climbed the rank, you got the gold watch. But that world no longer exists. Today, we are operating in a macroeconomic environment defined by elevated, sticky inflation, aggressive tax brackets, and extremely high localized service costs. Yet, people still blindly follow the old playbook. They view themselves as an employee rather than a business. If you want to optimize your wealth, you have to start running the math on the earnings before interest, taxes, depreciation, and amortization of you. I call this the EBITDA of you. Every time you accept a new role, you are essentially acquiring a new revenue stream. But you are also taking on the massive operating expenses required to service that revenue. The gross to net illusion is the most dangerous blind spot in personal finance. We see the big number on the offer letter, and our brains immediately start spending it. We mentally buy the nicer car, the better vacations, and the premium zip code. But gross salary is a vanity metric. It tells you nothing about the actual profitability of your daily existence, or how fast you are moving toward true financial independence. If you think a $30,000 raise sounds like a fast track to wealth, wait until you see the hidden lifestyle invoices that come attached to it. Let us break down the brutal math of the promotion trap. We will use the exact scenario I mentioned earlier. You are a highly efficient individual contributor making $130,000 a year. You are offered the director role at $160,000. It is a 23% increase. On paper, it is a no-brainer. But let us run this through the grinder of reality. Step 1 is the tax drag. Moving from $130,000 to $160,000 pushes those marginal dollars into higher tax brackets. In a standard U.S. tax scenario, combining federal brackets, an average state tax, and FICA, you are looking at roughly a 37% marginal tax drag on that new money. Furthermore, phase-outs for certain deductions and child tax credits often trigger right at these income levels, acting as a hidden secondary tax. When you apply that 37% tax drag to your $30,000 raise, the gross number evaporates quickly. Your net realized raise is actually about $18,700 a year. That breaks down to roughly $1,500 a month in new take-home cash. Now, $1,500 a month is nothing to scoff at, but it is barely half of the headline number your boss offered you. Most people stop their calculations right here. They accept the $1,500 and assume they are still coming out ahead. But they are completely ignoring step 2 of the equation, which is the unrecoverable promotion costs. A promotion to director rarely means doing the same job for more money. It fundamentally alters your personal operating expenses. It shifts you from a predictable 40-hour week, where you can leave your work at the door, to an unpredictable 55-hour week, where you are constantly on call. You are no longer just managing your tasks, you are managing people, crises, and corporate politics. That shift requires cash to survive. Let us itemize those new personal operating expenses. First, you have the commute and office presence. The new role mandates a strict return-to-office policy, or increased travel. That is an extra $3,000 a year in transit and vehicle depreciation. Then comes the convenience tax. Working 55 stressful hours exhausts your cognitive bandwidth. You are too tired to cook, so you order dinner delivery. You are too tired to mow the lawn or clean the house, so you outsource it. Add $6,000 a year for buying back your own energy. Next is the wardrobe and signaling upkeep. You are a director now. You cannot wear the same beat-up sneakers. Add $1,500. Finally, there is health and stress degradation. You need coping mechanisms. Maybe it is more expensive vacations, premium subscriptions, therapy, or future medical costs from chronically elevated cortisol. Add $2,500. Your total new operating expenses equal $13,000 a year, entirely required just to maintain your ability to perform the new high-stress role. Now for step 3, calculating your true financial gain. We take your net realized raise of $18,700 and subtract your new operating expenses of $13,000. Your true cash flow increase is just $5,700 per year. Let us look at step 4, the true hourly rate breakdown. In your old role, making $130,000 for 2,000 hours of work, you were earning $65 an hour. In the new role, you are working 15 extra hours a week, which is 750 extra hours a year. You are trading 750 hours of your limited time on Earth for just $5,700 in true net gain. Your yield on that marginal time is exactly $7.60 an hour. By taking the promotion, you have effectively taken a second job working part-time for minimum wage, while absorbing all the legal and corporate risk of middle management. Your net worth velocity barely moves, but your optionality and health are severely impaired. Most people stop here and lose $50,000 by chasing a title they do not need. If the math is so clearly terrible, why do totally rational actors blindly accept $7.60 an hour for marginal compensation? The answer is that corporate structures are masterclasses in exploiting behavioral economics. The first culprit is the Peter Principle and ego signaling. The Peter Principle states that people are promoted to their level of incompetence. In game theory, accepting this promotion is a status maximization move, not a wealth maximization move. Your brain is wired to crave status. When you hear the word director and see the gross number of 160,000, the dopamine centers in your brain light up like a pinball machine. These are massive social rank indicators. The dopamine hit temporarily blinds the analytical, rational part of your brain that should be calculating the net yield. You are reacting to the biological imperative to signal success to your tribe, rather than the financial imperative to build actual wealth. Once the ego takes the wheel, you fall straight into the Diderot Effect. Named after the French philosopher Denis Diderot, this is a systemic spiral of consumption where acquiring one new upgrade forces you to upgrade everything else to match it. You are now a director. In your mind, and in the eyes of your peers, a director cannot drive a 10-year-old Honda Civic. You suddenly feel the intense pressure to lease a BMW. A director does not vacation in a cheap rental property, they go to the premium resort. The promotion mathematically requires you to spend whatever tiny net margin you had left just to validate the new social tier you have entered. It is a systemic lifestyle creep that you cannot easily control because it is tied directly to your professional identity. The corporation gives you the title, but you end up footing the bill to maintain the illusion of wealth that the title demands. Beyond lifestyle creep, we are also trapped by the sunk cost fallacy of tenure. Employees often feel they have put in the time and paid their dues to earn this promotion. Refusing it feels like wasting the last 3 years of intense effort, even if the math proves it is a net negative. But the most dangerous hidden penalty is optionality decay. This is the invisible risk everyone ignores. You lose your asymmetric optionality. Middle management and director roles are historically the most fragile positions during a corporate restructuring. An individual contributor is a revenue generator or a core operator. A director is an overhead expense. In a modern macro environment driven by artificial intelligence efficiencies and flattened hierarchies, overhead is the first thing cut. By taking the promotion, you increase your target profile for layoffs. Simultaneously, because you are working 55 hours a week, you have zero time left to upskill, pivot your career, or build external assets. You are trapped in a high-risk, low-reward dependency loop. Think of the psychology of the promotion trap like the engine overclocking fallacy. Pushing a computer processor from 90% to 100% capacity might yield a 10% increase in processing speed. But doing so requires 50% more cooling power and degrades the hardware's lifespan by half. Your brain and your nervous system are the hardware. The promotion is the overclocking. The tiny bump in output is not worth burning out the machine. Or think of it like a corporate subprime loan. A title promotion is often structured exactly like a predatory adjustable rate mortgage. You get a fantastic teaser rate up front, which is the massive dopamine hit of the new title and the congratulations from your peers. But in year 2, the balloon payment comes due. That payment is extracted from you in the form of brutal burnout, massive tax drag, and severe health deterioration. You end up underwater on a career move you thought was going to make you rich. This is where conventional wisdom says you should just be grateful you have a job and try to save your pennies. I am going to tell you to completely change your entire framework. Optimizing wealth requires decoupling your career progression from your net worth velocity. Do not rely on vague advice. Use a precise, algorithmic framework when you are offered your next promotion. Rule number 1 is the true hourly wage break-even analysis. Before accepting any promotion, you must calculate your projected outcome. The The formula is simple. Take your new net post-tax salary and subtract your new unrecoverable lifestyle costs. Then, divide that number by your total yearly hours, plus commute hours, plus the invisible off-the-clock worry hours. If the true hourly wage of the new role is lower than your current true hourly wage, the promotion is a mathematical demotion. You are subsidizing the company with your free time. You must either reject the offer or aggressively negotiate the base pay up to parity. Never accept a pay cut disguised as a promotion. Before we get to the specific demands you need to make during that negotiation, we need to talk about execution. You can learn all the math in the world, but if you do not track it, it does not exist. That is why I built Cash Class, the official Tom Talks Money web app. Cash Class is the bridge between learning these concepts and actually implementing them in your life. I designed it specifically with a privacy-first angle. There are absolutely no bank logins required. You just securely upload your CSV statements directly from your bank, and the system helps you map out your true cash flow. It even includes a completely free Budgeting 101 course to get your baseline established. If you want to stop guessing and start optimizing, click the link at the very top of the description below to start your 14-day free trial on the web. Once your numbers are dialed in, you apply rule number 2, the 30% net margin hurdle rate. Adopt a corporate finance mindset. Private equity firms do not take on major operational risk without a commensurate hurdle rate. Set a personal hurdle rate of a 30% increase in net free cash flow, not gross salary. If the promotion does not clear this hurdle, the risk-adjusted return on your human capital is strictly negative. If you find that the net cash flow does not meet your 30% hurdle rate, you move to rule number 3, the equity and asymmetry demand. If a promotion demands a 30% increase in your cognitive load and steals 15 hours of your week, you must demand compensation in non-linear assets. Do not just blindly trade linear time for linear, heavily taxed dollars. Swap your base salary negotiations for restricted stock units, performance bonuses tied directly to gross revenue targets, or actual company equity. You want upside potential that scales without requiring more of your physical time. If you are going to take on the stress of being an overhead expense, you need to be compensated like an owner, not an operator. If the company refuses to offer asymmetric upside and insists on just a minor bump in heavily taxed base pay, you have your answer. The transaction is one-sided, and you are the one holding the bag. If negotiations fail, or if you simply do not want the stress, embrace rule number 4. The coast fire and side asset alternative. Coast fire refers to having enough invested that you can just coast on a comfortable salary while compound interest does the heavy lifting for your retirement. If you are a highly optimized individual contributor making $130,000, working 35 to 40 hours a week, and consistently hitting your savings rate, the mathematically superior move is often to just stay exactly where you are. Protect your time ruthlessly. Take the surplus 15 hours a week that the promotion would have stolen from you and deploy it toward your own balance sheet. Use that energy to build a tax-advantaged side business. Use it to aggressively research and manage your investment portfolio. Or simply use it to optimize your physical health and sleep. Being incredibly healthy lowers your lifetime medical costs and extends your compounding years. Your health is the ultimate financial multiplier. Before I give you the final framework, if you want to take this conversation deeper, click the join button below to become one of the optimizers. As a channel member, you get priority replies to your comments and custom sketch badges next to your name to show you are part of the inner circle. We love having new data-driven thinkers in the group. Ultimately, the promotion trap comes down to the diminishing marginal utility of income. High income is the water, but your net worth is the bucket. A promotion turns up the water pressure coming out of the hose. But if the pressure is so high that it punches holes in your bucket through stress spending, convenience taxes, and lifestyle creep, The bucket holds the exact same amount of water. You are just getting wet and exhausted holding the hose. Studies consistently show that beyond a localized threshold, usually around $120,000 depending on the cost of living, the actual utility value of each additional dollar drops precipitously, while the time cost to acquire it scales exponentially. Taking a high-stress promotion also exposes you to a human capital version of sequence of returns risk. In finance, this risk usually applies to retirement portfolios crashing right when you need the money. In your career, taking a toxic promotion and suffering a major burnout or health crisis in your peak earning years, usually between ages 35 and 45, destroys your lifetime compounding curve far more than simply plateauing at a comfortable salary for 2 decades. The opportunity cost of capital is too great. If you invest 15 hours a week into a promotion yielding $5,000 net, you are completely neglecting the opportunity cost of investing those same 15 hours into an S&P 500 index strategy or running real estate analysis. Those external assets historically yield 7 to 10% compounded annually on a growing base, completely free from payroll tax, and they do not call you on a Sunday morning demanding a status report. The next time you are offered a massive raise and a shiny new title, take a breath. Let the dopamine wash over you, say thank you, and then go home and run the brutal math. Calculate your true hourly wage, factor in the unrecoverable lifestyle costs, and demand asymmetric upside if you are going to take on the risk. Your career is simply a tool to generate capital. It is not your identity, and it is certainly not a reason to sacrifice your health and your freedom for $7.60 an hour. I want to hear your numbers. Drop a comment below with your own true hourly wage calculations, or a time you realized a promotion was actually a demotion. Consider it peer review for the community. It helps everyone gather better data. Stay rational, run your own numbers, and I will see you in the next one.